Welcome back to another episode of Plan Life Right, the podcast where we help you protect your future, grow your wealth, and sleep better at night knowing your family is covered. I'm your host, Kevin Ross, and today we're digging into a story that's far too common and far too preventable. My guest today is not just an advisor, but a trainer, strategist, and someone who works with financial advisors across the country. He's helped countless advisors protect their clients the right way. Please welcome my co-host, Matt Floyd from Advisor Rescue. What's up, Matt?
It's great to be here, Kevin. And wow, this one hits hard. One of the advisors I work with at Advisor Rescue brought this case to me last week. His client, a married couple, both in their 40s, bought a $300,000 term policy about 10 years ago. It felt like the right number back then. But fast forward a decade. They've had two kids. They bought a house. Inflation has gone up, and now they realize $300,000 wouldn't come close to replacing one spouse's income, covering the mortgage, sending the kids to college, keeping the family financially afloat even for 5 years. Um, so that number just doesn't work anymore. Now they got to replace it.
Yeah, that's the exact scenario from one of the MSN articles I saw. The wife and said something like, "We felt proud buying 300,000 in our 40s, but now I know it wouldn't be enough even if one of us passed." So what stood out to me was her realization. We didn't know how much we actually needed, she said. They assumed a round number was safe, but they never actually did the math.
And that's the danger. People see a number and think it's plenty. But by the time reality hits, inflation, college, healthcare, aging parents, that number starts to look pretty small. $50,000 back in 1940 was a fortune.
Yeah, right.
But you're dying in 1980 at $50,000 is not that much anymore.
So let's talk about term insurance. What is it? What it isn't? And why is it failing so many families?
Well, term is like you're renting your life insurance. You only get a payout if you died during the term, and statistically, most people don't. Less than 2% of term policies ever pay a death claim. That's great for the insurance company, but that's not great for your family. And I always tell my advisors and my clients that I've sold cash value life insurance to, when you take out a term insurance policy, there are two bets that are made. One is by the insurance company. They bet they're going to get to keep all of your premiums and never have to pay it out. The other bet is made by the policy owner. They're betting they're going to die sooner rather than later.
That's right.
The policy owner loses both sides of that bet. So I don't think it's a good product to put anybody in.
Yeah. So people spend 20 to 30 years paying into something, and 98% of the time it ends with zero.
Right.
They just wasted their money.
Yeah. And if you live a long life, which by the way is the goal, you want to die later rather than sooner so you can experience everything life has to offer. That policy expires and your family gets nothing. That's why I call it, feel good insurance. It makes you feel covered right up until you're not.
Yeah, that's right. And so you've been paying for nothing. That's why we always say term's a short-term solution. It's not a long-term strategy.
Exactly.
So Matt, how much insurance does a family really need? That's a big question, you know.
As much as they can afford.
Yeah, right.
Because there's so many more uses for life insurance beyond the death benefit.
Yeah.
That's that. If you're selling death benefits, you're selling death insurance. You're not selling life insurance.
Yeah. So do a math equation, because some people are like, I need to know the right amount of term. And what I see over all the years I've been doing this, everybody, when they're buying term or whatever, that they're always underinsured because they bought it maybe when they were 30, and then now they're 50, and they have had success in their life, and they're so far underinsured. If something did happen to them, colleges are going to get paid for, and all the other things that are goals in life, they won't be seen if something were to happen to either one of the spouses. So give them some of the basic math numbers.
I'll use round numbers so it's kind of easy. If you've got, let's say, $50,000 in income, you're going to need 500,000 to 750,000 in coverage. If you have 100,000 in income, you're going to want 1 to 1.5 million. 150,000, you're looking at 2 million or more. A good calculation, 10x. What do I
Right.
make? What's 10 times that?
Right.
Cuz in the real scope of things, you make $50,000 a year over the next 10 years, you would bring in $500,000 for your family. You're not going to be here for the next 10 years. You better make sure you can put 10 years worth of salary on the
That's
table.
right.
And these numbers are all before you factor in college, debt, inflation, paying off your mortgage, things like that. This is all just bill money and food on the table money is what you're looking for. You maybe paying for
That's
your
right.
funeral and things like
Yeah, it's not about dying, it's about what happens
that.
after.
Right.
Your income disappears, but the mortgage doesn't, the daycare doesn't, groceries don't, and your kids still want to go to college.
Exactly. If you're hearing this and wondering what your number is, go to www.planliferight.com. Click Get My Quote for a quick, instant life insurance quote. No calls, no pressure. If you want us to reach out, our number's there. You can always call us. We'll walk you through the process if you want just a little bit more information as
Yeah.
well.
So, yeah, if you want a custom plan, you go to that website, www.planliferight.com, and click book a consult, which will then schedule a meeting and we can go, build something that fits your family's future and not just today's paycheck.
Yeah. And hey, if you do think you're covered, book that consult anyway, because
Yeah.
it's a free second look at your situation. If you're perfectly insured, we'll be the first people to tell you, like, no,
Right.
and we'll congratulate you on doing something
That's right.
a third of the
So,
country doesn't
so
even know how to
basically,
do.
you can, if you're the person that doesn't want to talk to anybody, you do everything via the phone, via the computer. There's an option. You click it on and it will tell you, hey, this is what, $1 million policy. You're 25 years old. You want a 30-year term. It's going to cost you probably about $17 a month on our website, maybe even cheaper. Um, and you don't have to talk to anybody. It takes you straight from the information that you've given it, and it can have you a quote immediately, and you can fill out the paperwork right there without ever having to talk with anybody. So for those that don't want to talk to and don't want the consult, it's super easy and you don't have to do it. But if you do and you want to get
Right.
into some of the other stuff we're going to talk about in this episode, then hit that book the consult.
Yeah. Self-service and full service.
That's right.
We got it. We got it all.
All right, Matt. So let's talk about an alternative to term insurance, and that's cash value life insurance. And today we're going to do one of my favorite breakdowns. And I've taught you this way back: the good, the bad, and the ugly. Good old GBU.
Yep.
Let's start with the good, Matt.
This is where cash value life insurance, especially index universal life, really starts to shine. This is life insurance, just like term insurance. It pays a death benefit when you die, just like term insurance. But an IUL is permanent insurance. It builds tax-free cash value. Your premiums are not just going to an insurance company. It's almost kind of like they're going into a savings account that you can
Yeah.
access anytime you want. You can access that money during retirement. You don't pay any penalties or taxes. If any of you have ever taken money out of your 401k, you were hit with 20% right off the top for withholding and another 10% penalty if you were below 59 and a half. So
Right.
this is a way to get at money you've been saving tax free and penalty free. Doesn't count as income for Social Security and Medicare because you're just going to getting your own money. Just like going to the bank, you take $500 out of your savings account. You didn't make $500. You don't have to report that. It
Right.
was already your money. And like I said, you're still protected with a death benefit for your family in case something happens.
Yeah. So unlike a 401k where you got taxes waiting for you at the end and IUL's tax free
Mhm.
when it's structured right. That means if you take $50,000 a year out of your IUL in retirement, it won't raise your Medicare premium or push your Social Security into a higher tax.
Right. It's like hidden money.
Yeah.
It's like the government doesn't see it, so they can't tax you on it. But now you compare to pulling 50,000 from a traditional 401k or a regular IRA. that gets taxed as ordinary income. You're automatically in the $50,000 tax bracket.
That's right. That's
Right
right.
off the bat. And that could push you into a higher tax bracket and make up to 85% of your Social Security taxable. It's 85%, right?
That's right.
Yeah.
Yeah.
I mean, that's insane.
Yeah.
That's money you've already been taxed on,
I
and
know
now you're
they're
getting taxed
double
again.
taxing you. You know, Trump's been talking about removing it, but right now this is the way it is, and everybody that's in retirement taking their Social Security, this is stuff that they're really facing. And by the way, if you're in your 20s or 30s saying, "Yeah, Trump's going to get this thing passed," he may, but that doesn't mean the next generation, the next president, the next
Exactly.
could do
Yeah.
exactly
Just
what
comes
the
in and
last
erases
guy
it
did
all.
in
Yeah.
between the two, and run taxes, awry again. So.
Right. And all that taxes that could also, seniors are all on Medicare.
That's right.
And you got to get that Part A, Part B, Part C. I mean, that can make your Part B jump $200 or more per month
Yeah.
when you're not working anymore.
Yeah,
And you don't have an ability to make an extra
That's
$200
right.
a month.
Did everyone hear that your Medicare could jump up to $200 more per month? You're already paying, whatever the number is based on your income. It could jump up $200 more. That's $2,400 more a year.
That's today's dollars. We're not even talking about what it's going to be like when I turn 65.
Exactly. So let's be real. Now, let's talk about what's the bad, because obviously everything's good, got a good, a bad, a ugly. What's the bad?
Everything
Talk
comes
about
with
the
a
bad.
catch.
That's
Yeah.
right.
So it's not free. You're going to pay higher premiums than term, but that's because you're funding an asset. You're not just renting a policy. It's pretty easy. Think about it as, what does it cost to have car payments for 3 years on a
Right.
loan versus what's it cost to rent a car for a week?
Right.
If you compare those two numbers, you're paying a price for a car, but you're owning one versus buying
it's
one.
comparing a rental. It's like comparing a rental car to buying a luxury SUV.
Yeah, you go buy an S500 Mercedes, you got one payment.
Yeah, you get what you pay for, right?
Yeah, you rent a Kia for a week to go to the beach, you got another payment.
That's right.
And if you're just looking at it's a price for a car,
Right.
then you're missing the whole boat. But the ugliest part, man, that's when someone buys the wrong product,
Right.
like whole life, and then they get locked up into low growth and premiums until the day you die, or at least until you turn 100.
Right.
Some of them are taking it out to 120 nowadays. But whole life often only pays 3 to 4%, maybe 5% if you got a sweetheart deal or somebody's
Mhm.
running a special. But with IULs, you have the market length growth potential without any of the downside. So unlike whole life, you don't have to pay premiums forever. You can pay it for 10 years, or you can pay it just until you turn 65 or until you turn 75.
Yeah.
You can turn it on, you can turn it off, and you got that market length growth. You got flexible premiums, whole life. If they tell you your premium's $250 a month, it's $250 a month this month.
Right.
It's $250 the last month.
Right.
But with flexible premiums, and the ability to stop paying, you can really kind of customize it to whatever your financial needs are as
Yep.
you grow throughout your own life. You can see where your money's going and watch how it's growing.
Yeah. So that's the game changer. People hear cash value life insurance and assume it's old school whole life, but the modern IULs give you a much better flexibility, better upside, and you can design it to pay up after as short as 5 years to 10 years, and let it grow tax free for decades. So you got a lot of different opportunities. Maybe you're in a position where you get bonused at the end of the year. Well, you could take that bonus money or part of that bonus money and fund extra into that IUL.
Exactly.
Right.
Yeah.
And now
Pump
you're
up
just
that
giving
cash
it more
value.
juice. Right at the beginning. So a lot of cool things you could do with that, and not get stuck in the old school whole
Right.
life.
And back to that couple at the beginning, they had the $300,000.
Yeah.
Well, over the course of their life with an IUL, you can overfund an IUL. You can't overfund a term insurance
That's
policy.
right. Yeah.
So you had
The insurance carrier would like you to.
yeah, they would
overfund.
let you. Yeah, but your family's not going to see it. But once you got your policy paid up to 300,000, you can just keep dumping money in there. You
That's
dump
right.
another 20,000 in there. Now your death benefit's 320. Dump
Right.
another 50 in there over several years. Now your death benefit's 370. So it grows with you. It's flexible. That's the best part about it. It's
Right.
way more flexible. It's not rigid like whole life.
Right.
But you want a side by side. That's what everybody wants. Like, how's that compare? So, and this is about tax free versus taxable money.
Uh-huh.
Everybody wants that side by side. So you got your retirement account. You withdraw 50,000, like we said. Net after tax impact on Social Security um, turns into about $38,000.
Yeah. So your 50
Um,
turns into
yeah,
38,000.
$12,000 right off the top. 85% of your Social Security now gets taxed.
Right.
Medicare goes up. With an IUL, you take $50,000 out of it as a loan. You just lend it to yourself.
Right.
You're good for it. Um, there is no impact on Social Security. Medicare is untouched. Income tax is untouched. You got $50,000 richer, and the government is none the wiser.
It's really kind of a no-brainer, but I think so many times, and we worked with advisors, they don't know how to explain it to the
Right.
client the right way, and the client doesn't understand how to or process it right. So they just default to, well, just give me the most term, and
Right.
then you turn 60, you're like, I've been paying for 40 years this 500,000 or $1 million term life, and now my premiums have doubled or
Mhm.
tripled, especially if you've got some issue that's happened, and so you could be uninsurable. However, what's funny is if you go back and you say, okay, a 25-year-old does a $500,000 IUL. They pay for it for 10 years, for example. That money that they pay and they don't pay anymore is usually less than what that 60-year-old, especially if there's been something that's happened in their life,
Absolutely.
on a term insurance for the next
Yeah.
15, 20 years when they might actually need something to give to their
Right.
beneficiaries. So that's a huge thing. So let's look at this. So if you're 40 to 55 right now and you're just funneling money into a 401k without tax diversification, you're setting up for a tax bomb in retirement.
And it hurts you two different ways. It's not just, the concussion blast of the bomb. There's a burn after too.
Right.
So you got the taxes on the withdrawal and increases on what you pay for Medicare and how much of your Social Security is taxed. And you lose the earning potential of having that money in your 401k because that money's coming directly out of that nest egg. So now your $1 million is only $950,000
Right.
and its earning interest is $950,000. You got $1 million cash value in a life insurance policy and you take $50,000 out of it, you still got $1 million in your life insurance policy because that's not where that money comes from.
Right. So qualified money like 401ks and IRAs, they sound good now, but in retirement, it's the most heavily taxed money you'll ever touch.
And that's where IULs step in, not as a replacement for a 401k, but as a smart addition that builds tax-free wealth and protects your family all at once.
Yeah. So if you're a parent, a provider, or someone who wants to retire smart, go to www.planliferight.com. Click on Get My Quote for an instant life insurance estimate, or sign up right away. Or if you really are like, hey, I want to know a little bit more about this IUL and how that works, click book a consult, and we'll build a plan based on your goals, your income, and your family needs.
And if you're a financial advisor right now or a life insurance agent and you're listening and you want access to this kind of concierge level case design, product strategy, and client protection, that's what we do here at Advisor Rest. Most of our competitors just throw you into a quote engine. We give you strategy, coaching, and elite support. If you need help closing your client, we're a phone call away. We can explain it to them if you're not able to. But go to advisorrescue.net. Book a consult with me directly. There's a link there. It books directly onto my calendar. Let's grow your business and protect your clients the right way.
Yes. So let me leave you with this. Most people don't realize their biggest risk isn't dying too soon. It's living too long without a plan. That $300,000 term policy might have felt like a smart move 10 years ago, but it doesn't protect your income, your spouse, your kids, or your retirement. Then it's just a number on paper, right?
And if you're relying on taxable money like a 401k or an IRA to fund retirement, you're playing the government's game. And they don't lose.
Yeah,
I don't know them to lose much. Taxes go up, your income goes down, and your Medicare and your Social Security, they also suffer.
that's right.
That's not protection, that's exposure.
Yeah, so you've got two choices right now. If you're a family looking for real protection, visit www.planliferight.com, click Get My Quote for instant numbers, or book a consult and let us custom build your plan. No fluff, no pressure, just smart protection. Sure. And if you're a financial advisor tired of quote engines and generic products and you want a true partner in your corner, go to www.advisorrescue.net, book a call with Matt, and let us show you what elite level support actually looks like.
Yeah, we don't just run quotes, we build strategies, close cases, and protect families. If you're serious about scaling the right way, let's talk. And I think the best part about our help is it's free.
Yeah. So thanks for tuning in. If this episode gave you clarity or conviction, don't keep it to yourself. Share it with someone you care about. Plan smart, plan with confidence, plan life right.
And remember, life insurance is love insurance.